Welcome to the Daily Drawdown with the Fed chips and AI all repricing risk. Three pressure points are driving the tape right now. The Fed got less predictable, AI buildouts got more balance sheet intensive, and the chip story got a lot more political. Those all feed directly into valuations, pricing power, and what breaks first if execution slips. The biggest macro shift is at the Fed. The new chair came in hawkish, pulled back on explicit forward guidance, and told markets they should expect more flexibility and more surprise. That matters because clear guidance suppresses volatility. When the Fed stops pre-committing, traders have to price a wider range of outcomes, and that raises the risk premium across rates, equities, and credit. The policy split is real. Roughly half of officials were signaling at least one more hike this year, and markets quickly moved to price about a 70% chance of a September hike, with more tightening still showing up in 2026. The market reaction was messy. Stocks sold off hard at first, then partially retraced, while the curve moved in a way that said short-term policy risk is up, even if longer-run growth confidence is shakier. What to watch next is whether the Fed's internal review changes the inflation framework or communication style more formally. Even talk of moving from a strict 2% point target toward a range would be a meaningful regime change. That Fed shift matters even more because big tech is no longer operating like a rate-insulated fortress. AI infrastructure spending is massive, with estimates running from roughly $750 billion to $1 trillion across chips, data centers, networking, and power. A lot of that build-out is now leaning on debt markets. Shelf offerings, bond deals, and compressed free cash flow mean the largest tech names are getting more sensitive to financing costs at exactly the moment policy got less predictable. The practical point is simple. If AI demand stays hot, capex beneficiaries still win, but the financing math gets tighter. Higher rates can start to constrain buybacks, dividends, and valuation multiples even when revenue narratives stay strong. One useful frame from the panel was CLAMS: compute, light, architecture, memory, power, and stack. That's where to track who actually captures margin as this cycle broadens beyond just GPUs. Power is a real bottleneck here. EQT's CEO put potential AI-driven U.S. gas demand growth at 15 to 18 billion cubic feet a day over 5 years, which tells you this isn't just a semiconductor story anymore. On semis, the loudest single-stock move came from reports of a possible Apple-Intel partnership to design and build some chips in the U.S. The key caveat is that the reporting was unconfirmed, and neither company put out a formal, clean announcement. Even if something is real there, the early read is that this would likely start small. Think low-volume or Mac-class parts. More about supply chain diversification and proving domestic foundry capacity than moving the needle on flagship iPhone silicon right away. That distinction matters because the stock reaction was much bigger than the near-term revenue math. Some estimates put Intel's potential share of Apple's foundry spend in the single digits, which is helpful, but not enough on its own to justify euphoric pricing. The actual bull case for Intel is still the foundry transition and the 18A pipeline. That's a long-duration execution story, and many analysts don't expect the foundry business to be solidly profitable until around 2028. So what matters now is yields, timelines, customer uptake, and whether margins can improve from roughly 40% toward peer territory. Until that shows up, a lot of Intel's valuation is still forward belief rather than present economics. The more immediate hardware story is memory. Hyperscalers have been soaking up DRAM and high-end memory supply, pushing prices sharply higher and leaving consumer device makers squeezed. Some of the numbers are striking. Certain memory costs were described as up roughly fourfold over 3 quarters, and one teardown had iPhone DRAM moving from around $40 to roughly $145. If memory is around a fifth of the bill of materials, that gets hard to absorb. Apple has already warned that higher memory and storage costs are likely to force device price increases, with estimates running from about $100 to as much as $200 or $300 on higher-end models. Why it matters is that this is one of the cleaner examples of AI demand spilling into the real consumer economy. Data center buyers can outbid handset makers, and that can delay upgrade cycles while pushing Apple to protect margins by leaning harder on pro-tier pricing. Watch for whether supply relief timelines keep slipping. Several analyses suggested meaningful new capacity may not ease things until after 2028, which would keep the squeeze in place much longer than a normal component cycle. In commodities, the US-Iran memorandum helped push oil down into the low 70s, which is helpful for headline inflation and gasoline prices in the near term. The problem is that the operational details still look fragile. The Strait of Hormuz transit terms, possible tolls later on, constrained tanker availability, and demining issues all leave plenty of room for supply disruptions or renewed price pressure. So for markets, this is relief, not resolution. Lower oil helps the inflation backdrop today, but traders still need to respect how quickly shipping risk can put geopolitics back into the barrel. One quick note on market structure. SpaceX's IPO became a volatility event immediately. Huge volume, aggressive options activity, and then an implied vol reset as traders repriced the frenzy. The bigger issue is supply. Large lockup tranches and additional price-triggered share releases create a clear near-term overhang, which makes this one less about the story everybody loves, and more about whether the market can actually absorb the stock. That's also a broader warning. Retail options concentration and oversized single-name wagers are back in force, and that tends to amplify both upside overshoots and ugly air pockets when sentiment turns. The through line across all of this is repricing. The Fed is less explicit. AI is more capital-intensive. Intel's upside depends on execution, not headlines. And memory scarcity is starting to hit consumers directly. So the watch list is straightforward. September hike odds, credit market funding for hyperscalers, Intel foundry milestones, DRAM pricing, and whether oil stays contained. If those all stay manageable, risk assets can keep grinding. If 2 or 3 worsen together, valuation support gets thin fast. That's the brief for today from the Daily Drawdown. Thanks for listening. This episode was generated by Podkey. Create your own at podkey.fm.